Hey, how you doing? So in this video, we're going to be talking about ICT mitigation blocks. What are they? How to identify them? All that good stuff. So I'm going to use this AUD/USD from yesterday for an example. So me and my mentees, we were talking about this AUD/USD, and I was telling them, look for that reversal in New York session. Okay, look for that reversal in New York session because on AUD/USD yesterday, the higher time frame trend bullish. All right, 4-hour chart bullish, 1-hour chart bullish. But then you can see on this 15-minute chart right here, we've been consistently selling off for a little while at this point into London session and then into the beginning of New York session. You can see how AUD/USD was just consistently selling off. It's consistently making new lows. It's putting in lower highs. It's consistently selling off right here. And what we saw happen, if you look at my cursor right here, what was just put in right here? Again, this is in New York session. It puts in a swing high right here. See this? See how we have our highest high right here? We have a lower high on the right. We have a lower high on the left. That puts in a swing high. And in simplest terms, that means it is potentially topping out right here. It's about to roll over and take out this low for that next leg lower, just like it's done before, just like it did right here, just like it did right here, just like it did in the past. And you're looking for that same pattern to occur. So it looks very, very bearish here on the lower time frame chart. But as I was saying, look for that reversal, look for that reversal. So what happens here is it's going lower, and we have a lot of existing shorts, big existing shorts, okay, that are looking for that next leg lower, that are looking for that continuation. But then what happens next? After it looks like it's going to do this, it looks like it's going to take out this low. It's getting very close. It's just nearing that level. It looks like it's about to sweep it, and then boom, it ramps up. It gets that reversal that I was talking about yesterday, and it has a shift in market structure. What is that? That's a change in trend that occurs. So look at this right here, and look at this through the perspective of, a big money short that is looking for lower prices, right? That's looking for lower prices. That's looking for this low to get taken here. And then what we see happen next is we see a big shift higher. We see a big change in trend. This is a failure swing. And this is also your mitigation block. So the mitigation block, it's going to look like a failure swing. That's what it's going to be. It's going to be a failure swing, and then it's going to be followed up with a change in trend. So you can see, as I said, we put in this swing high. It looked like it was going to come down and take the lows, and then boom, it has a big change in trend right here. It turns on the dime, and it just ramps up. So this was a failure swing, and it's also your mitigation block. So how does it get the name the mitigation block? Well, whenever price returns to this area, what do you think is going to happen? Because keep in mind, what did I just tell you? There's a big bucket of shorts that are looking for this thing to move lower. They're looking for this thing to get taken, for this low to get taken. So what happens when this thing ramps up like this? They're trapped. They weren't able to exit at where they wanted to. Okay, and then it comes up and it takes this liquidity up here, and now it's starting to sell off. Once price returns back to this origin, what do you think those shorts are going to want to do? Because they're in the red now. They're in the red once this thing ripped up like this. We had the failure swing about to take this low. It rips up. They're in the red. So once price returns to that origin price, because remember, this was a shift. This was a change in trend. Look right here. There's the top of the mitigation block. Perfection, right? So you can see it comes down into this area. It tests that level. They're able to mitigate their positions. In simplest terms, they're able to cover. And now they can reposition themselves and send it higher, or get on board that trend higher, basically. That's no coincidence why it had such respect for this level. I mean, it's this is where that change in trend occurred. Again, it looked like it was going to have that swing lower. It had a failure swing right here. It looked like it was to take it, then boom, it ramps up. Existing shorts are underwater. It returns to that point of origin right here. They're able to mitigate their positions, and they're able to get on board the trend higher, because we had a shift right here. That's where the change in trend. So that's what happened. The short-term trend, the higher time frame trend was already bullish, but the short-term trend was bearish. It was bearish. It was bearish. It was bearish. It looked like it was going to take out the low. We have the failure swing, which is essential for the mitigation, block. You need the failure swing, and then boom, it ramps up and it cracks that high. It then becomes support. It pulls back into a discount marketplace below 50% equilibrium in this price range. It tests your mitigation block, finds support, ramps up, takes the highs, and that was that. That is a good example of that mitigation block in play right here yesterday. Now, we had actually another example this morning on this AUD/USD right here. You can see this morning, AUD/USD, the short-term trend was very bullish now, because now we're ramping up. See how it's consistently putting in higher lows? Look right here, higher low, higher low, higher low. And then we have a little pullback right here. It pulls back and it comes down into this old high support right here. See this? Where my cursor's moving? We test that old high support, and what's put in off that support? We put in a swing low. We put our lowest low in the middle, higher low on the left, higher low on the right. In simplest terms, it means that price is potentially finding its bottom here, and it's ready for that next move up higher like it has been doing in the past. It's been consistently ramping up, taking out these highs. So you're looking for that same pattern to continue, right? You're looking to get on board. You're looking for this thing to go up higher. But then what happens after you put in that swing low? What happens next? Boom, you get a rug pull. It has a change in trend. It has a displacement lower. It creates this fair value gap. It has a very strong move lower that cracks this low. Okay. Now some of you might be thinking, okay, what is all this other crap you're talking about, like fair value gap, all this stuff? Well, I'll leave a link in the video description to my video on fair value gaps. So after you watch this one, you can go watch the video on fair value gaps. It's another ICT concept. So I'll leave a link in the video description on how you can identify fair value gaps, because it is essential to high probability market structure shifts. Okay. So we get the fair value gap. That's a lower time frame shift right here. And again, this is your failure swing, because look at this thing. You put in a swing low. It looked like it was going to take the highs, and then boom, it pulls the rug. That is a failure swing. Okay. And then it cracks that low. So we have a big bucket of longs that are now trapped. Okay. They're in the red on this push lower right here. So once price returns to this area, well, what do you think they're going to want to do? They're going to want to mitigate their positions. Okay. Because they weren't able to get that push up into this high right here. That trend wasn't able to continue right there. And now we have a change in trend lower, a bearish change in trend, comes back to that point of interest. They're going to want to mitigate their position. And then what happens? It comes up, it tests that level. They're able to mitigate their position. They're able to get out. And then now the lower time frame trend is on the 15-minute, it's bearish. Now this one it was kind of a difficult read, because, the 1 hour is actually, bullish, and the 4 hour was bullish as well still. And you could argue that this old high support on the 1 hour could hold up and it could ramp up and take this highs. That was a possibility. But here's the deal. The 15-minute, this is why it held up as resistance. We can see that now. That's why it held up as a resistance. We had the failure swing. We had the shift. Then it came up into a 15-minute premium. Okay. And it tested this old low level of resistance, which is your mitigation block, in a premium, and then ramps up a little bit, and then it sells off and it takes out the lows. It takes out that liquidity. Okay. So that's what we saw play out here on AUD/USD. Okay, so those are two examples of mitigation blocks, and basically, again, it's going to look like a failure swing. You're going to look like you're going to have that continuation on that trend, and then it's going to be a failure swing. You're going to have a change in trend. Then once price returns to that origin, you're going to have existing longs or shorts, depending on whether you're buying or you're shorting, or it's a bearish or bull scenario, are going to want to mitigate their positions, and then you're going to have a continuation. Okay, is it 100% success rate? No, but whenever you have all the things aligned, it's a nice scenario. So yep, that wraps up the video. Hopefully you enjoyed. If you did, leave a like, subscribe to the channel. I'll catch you later.